If you're confused about the stock market or wondering how you should be investing right now, I'm making this video for you. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. It is a very confusing time. You have one of the world's greatest investors, Michael Burry. He tweeted at the start of this week, sell, always the sunshine and rainbow sort. And a lot of folks are saying, oh, he goes by Cassandra. He nailed the Big Short, and yes, he nailed the .com implosion. But yeah, he's always this sort of perma-bear. At least that's the perception. He's actually called a lot of great stocks long. And then the next day, you get crazy volatility with major U.S. indices as Jerome Powell raises interest rates by 0.25%, 4.5%, 4.75%. And this is because he goes, look, it's uncertain. He talks about the uncertainty of how much further he's going to have to raise rates to tackle inflation, because he really wants to make sure that inflation is crushed. He wants to make sure we have price stability, because if he doesn't do it now, it's going to be even more painful over the next decade. He sees getting to price stability with housing and goods, but he's not sure about services, which is in large part driven by a distortion in the labor market. So if the labor market's really hot, it's very possible you have higher inflation for longer with services. And so that gets Wall Street a little bit nervous. But then he said, someone asked, well, what do you think about financial conditions? Have they tightened? Have they eased up? And he said, it's super tight. That effectively, he was saying it's tightened significantly over the past year. And that is not what Wall Street was expecting, because the reality is markets have gotten bid up significantly, including the debt markets in the last few weeks. And so Wall Street was like, hooray, this is great. He thinks things are tight. This means there's not a lot more going on. This is great. And so risk assets bid up significantly immediately after Michael Burry, pretty much tweeted sell. So then Michael Burry deletes his account. He goes back on Twitter a few days later, but a lot of people are dogging on him. Oh, Michael Burry, this guy worth a couple of $100 million. What's he know? One of the greatest analysts ever. What's he know? Because he clearly didn't get the short term right. And then you get a lot of retail investors. So the everyday mom and pa investors, they reach effectively a record volume in terms of market volume. They're excited to get in on this. And you see a lot of really, I think there's I think the formal correct technical term is crappy stocks. I think someone actually calls them, I don't know if I want to use the proper, the technical term here. I think the technical, if you have young children around, cover the ears. I think they call them shitcos. I think that's the technical term that we've heard. So I apologize for the language. And so, you see some of these companies just rallying like crazy, up like 100% year to date. And some folks are saying, well, wait a second, aren't these companies also reporting some terrible results? So, but anyways, a lot of the retail investors, they don't care about the fundamentals. They're just excited to the moon. So then you get another very sober investor, Ray Dalio. He's going, look, I previously said cash is trash, stocks are even trashier. Now he's saying cash isn't trash. It's certainly more attractive than stocks and bonds, which is really interesting for him to say. He's seeing the rally in stocks and bonds, and he's saying, you know what? For the risk that you're taking, it's just not worth it, because you're still in this part of the market cycle where the Fed is tightening. Eventually, you're sort of balancing these risks of, hey, if the Fed really wants to make sure they get price stability, there's a good chance they overshoot, resulting in lower earnings, in which case the risks that you're looking at from a stock and bond perspective, probably you're not being compensated for relative to holding cash. And cash is currently yielding, a favorable rate. I personally keep my cash at Interactive Brokers. That's where I keep my investment accounts. There's a link below. Currently, cash is now yielding over 4%, 4.08% at Interactive Brokers, which is one of the highest rates that I think you can get out there, especially relative to a lot of the major banks. And so then you continue to see a weird investment environment. You have folks like Ray Dalio saying cash is, that's actually what you want to hold relative to stocks and bonds. You see Michael Burry saying sell. You see the stock market ripping higher for a few days as Powell sort of says, I'm not quite sure, I'm uncertain, but I think financial conditions aren't, are tight, even though stock prices and bond prices have rallied, over the last few weeks. And then you have a really strong jobs number where unemployment now reaches effectively a record low for several decades now, 3.4% unemployment, payrolls rise by over 500,000. I mean, these are just incredible figures where you go, wow, the economy is red hot when you see this. And then you see just weird economic data as well. Where you see that some of the major tech companies, the Apple, Amazon, Google, Facebooks of the world, a lot of them are reporting, I got to say, really mediocre results at best, like flat or down. And, you're looking at Apple reporting a 9% drop in iPhone sales, partially attributable to weaker economic environment, partially attributable to a strong US dollar, but a weak economic environment is clearly part of the picture. Stock rips higher. Stock breaks higher because people just go, hey, to the moon. That you're starting to get this animal spirits again when you have more sober investors saying, well, hold on a second, like Ray Dalio's, Michael Burry's of the world saying, you know what, you're not thinking about the risk reward here. You do not have the Federal Reserve as your friend. This is very different than past parts of the market cycle where Federal Reserve is saying, hey, we're cutting rates or we're printing unlimited money. This is not where we are in the market cycle. And it's very weird to see Apple jump, a couple percent following what I'd argue is actually very weak earnings from them. Okay, so what's all this mean? How should you think about investing in this environment? First of all, quick plug, unrivaledinvesting.com is dedicated to helping everyday savers become better investors. Subscribers receive investment insights, compelling ideas, and my personal real-time portfolio updates. We also have an active community on our exclusive Discord server available only for our annual subscribers. I personally let in every single member there. I also recently launched 2 new investment courses for enterprising investors for the folks that want to learn how to read financial statements and also want to be able to size up as a stock that they own is at a promising or perilous valuation. A lot of folks were burned by overpaying in the last few years, so I thought it was important to have a valuation course at an affordable price. And in full disclosure, this is not financial advice. So one quick comment is Larry Summers, one of the greatest economists around, formerly the Treasury Secretary under the Clinton administration. He nailed it. He nailed it, folks. He called out, before the inflation started picking up, he said, this is going to be a problem. They should be raising rates. He called it out. He nailed it. Full credit there. And he's effectively saying like, hey, I thought there was going to be a recession in 2023. This is a really... He's effectively said this is one of the hardest economies to forecast that he's ever seen. Now, part of it's because, how much data points do you have? How many data points do you have about, pandemic post cycles where you have tremendous treasury and monetary stimulus? And so he's saying, look, it's really unclear. You're still looking at incredibly favorable numbers. And you see like at the end of the year, you saw manufacturing and production, industrial production leading indicators start falling. And now in the last week, you've seen it all of a sudden expand back into expansionary, so it goes from contraction to expansion. So he himself is saying, look, I'm not sure. And when you see an economist like Larry Summers, who in my opinion is one of the best, say, you know what, I'm just not sure. You see Jerome Powell say, I'm not sure. And you see, very intelligent investors like Michael Burry, Ray Dalio. You might not like Michael Burry. A lot of folks don't like him. I personally do. A lot of folks don't like him because he has this constant sort of he's often negative, but I think his analysis is very, very good. I think it's important to recognize a lot of these folks are either saying it's really uncertain right now or the risk reward isn't that compelling. So this should make you think, in my opinion, that you're dealing with greater uncertainty. That greater uncertainty means not only like, hey, there's downside, but it's a wider range of possibilities. It's possible you have a hotter economy for longer, but it's also possible that the Federal Reserve overshoots because, look, Powell has made it very clear he's going to do what it takes to get the job done. He's even called out the autobiography of Paul Volcker, the prior Fed chair, who is effectively saying, like, keeping at it. He's saying, yeah, I'm going to keep at it until the job gets done. I'm going to make sure there's price stability. He's going to keep raising rates. And so there is all these data points. I don't view this as a very favorable risk on environment, despite the fact that we've had a significant rally, 10% plus in the last few weeks. Given this sort of backdrop, I don't think that you have this sort of tailwind. And so I think that's very important to understand. I don't look at Apple, I don't look at Google, I don't look at Amazon, all of which, when I say I don't look at them, I'm saying I don't see them saying that there's favorable economic data. That's none of them are saying, oh yeah, the economy is just great. All of them are saying, yeah, it's tough times. All of them are saying, yeah, we need to do layoffs because things aren't growing as much as we expected, or there's challenges. Same thing with Meta. I mean, Meta ripped higher despite the fact they're talking about declining revenue. Their guidance included a negative 7% outlook for the quarter ahead. That was the downside. The upside was 2% growth. So you're looking at these things like none of these guys are looking, none of these companies, I should say, none of these companies are talking about, oh yeah, super robust economy, despite the fact that the unemployment picture looks great. So this is incredibly, the uncertainty and the potential range of outcomes, I'd say, is really wide here. And some of the best economists don't know how it's going to play out. And some of the best investors are saying, look, given these dynamics, it's better to be safe than sorry. So how can you apply that to yourself as an investor? Well, there's a concept that, Warren Buffett has taken to heart. He learned it from Ben Graham, and then countless other value investors like Seth Klarman have applied it over and over again. You see it, the name over my shoulder, which is that it's important to find a margin of safety. Ben Graham talked about, you don't drive over, a bridge that can support, let's say, 1 million pounds or something like that with a truck that has 1 million pounds worth of stuff. You need to make sure there's a margin of safety, so that way the bridge doesn't collapse. You should look for things that are obvious. You should look for differentials where you say, oh, this is, there's so much safety either in the quality of the business or in the valuation that I'm comfortable buying and holding in this environment. So when you see Michael Burry saying sell, you should be able to say, well, these are the reasons why I'm not going to sell, and have very strong reasons. And if you can't, then I would say you should check yourself. Check yourself before you wreck yourself. Because when you think about margin of safety, I think there's 3 different, types of margin of safety that you can think about. Feel free to add comments below if you think there's more. But I think the first one is sort of a deep value margin of safety, where it's based on some sort of liquidation value, where you're sort of saying, hey, this company trades below liquidation value, and therefore, it might be a portfolio of asset, might be a portfolio of companies. This business owns a portfolio of companies, and some of these companies are publicly traded. If you have something like that and it trades, let's say, at a 30% discount to that, that can be kind of compelling if you find some sort of liquidation play like that. Because then you're saying, well, even if Michael Burry's right, there's this huge margin of safety. Significant upside just to getting to some sort of liquidation value. So that's the first thought. Another thought in terms of getting that margin of safety is if you have a business with just tremendously, stable free cash flow, no matter what the economic picture is. I'm not talking about the Teslas of the world. The Teslas of the world are more cyclical, I suspect. When a consumer, is pulling back, that's going to impact their free cash flows. I'm talking about the businesses that are like financial toll booths on the economy, where no matter what, they're collecting sort of free cash flow coming in. Businesses that are incredibly stable. And you can always check it against, let's say, the great financial crisis or the dot-com implosion to see how did these businesses do, and are you paying a good multiple to that free cash flow? So that's the second type of margin of safety, is like, hey, I'm getting a great free cash flow yield. So even if the stock fell off, the stock price falls, there's going to be some sort of buyback or something like that. So that's that stable free cash flow. That's what I like to see. The third, in terms of margin of safety, is when you find something that's just so compelling. It's such a high quality business. It's a disruptor. It has hyper growth. We're saying, hey, the thesis here with this business is that even if there's a recession, because they have this product that's so good and so disruptive, and they're selling these new services, that I can still pencil out hyper growth, 20, 30, 40% growth. That's the reason why I'm going to own it. That is, in my opinion, those are the rarest and best stocks to find. It's very, very hard to find those types of things, but that's ideally something you want to own. Ideally, that's what you sort of concentrate your portfolio around, because that drives most of the value over a multi-decade period, that sort of strong growth. The challenge, and a lot of folks have woken up to it in the last few years, is that it's very easy to overpay for these things. And in periods where investors sort of wake up and say, hey, growth might come in a little bit lower than you expect, then in that case, the valuations really come under pressure. And that's the challenge, is like, hey, even if you have a hyper growth company, it goes from 30% growth to 20% growth. It's really strong growth. Otherwise, you might have an even greater drop in valuation. So that's why in this environment, it's so important to be aware of, in my opinion, the valuation in which you're paying for all these types of things. I personally try to have, one of each of these, at least in my own personal portfolio. I call them out to my subscribers at unrivaledinvesting.com. The type of company trading below liquidation value, type of company with like 80% plus recurring revenue, trading at a great multiple of free cash flow. And then the hyper growth businesses, where it's like, hey, it will be more volatile, but I think the thesis is here for strong 20, 30% annual growth in the years ahead. So it's important to have a diversified portfolio. At least, that's how I personally look at it, is each of these different buckets. But every investor has their own journey. I just think in this environment, you want to be really mindful, is what is that margin of safety? Because you want to make sure that if you don't have that margin of safety in this environment, just check yourself. You don't want to end up in a world of pain where you're saying, oh man, I actually ended up paying up for this cyclical business and I get hurt two ways. I get hurt both, let's say, the potentially economic downturn as well as lower valuation. That could be really painful, but we'll see. That's just one of the possibilities. It's a wider range of possibilities right now because even some of the greatest economists in the world, they're not quite sure how it's going to play out. And that's why it's so important, in my opinion, to have that margin of safety. If this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.